recap. So I wanted to walk through what we're looking at on the 10-year note because it's been one of those crazy weeks where the good news is bad news. Frankly, the bond market as a whole struggled ever since that big print on the jobs report came out last Friday. And so it really did knock things off our perch, and it met some real technical key levels when that number came out. So again, this is a 10-year note yield. This purple line is the 200-day moving average, which is essentially just the average yield of the last 200 days. And it's an important level because it doesn't go above or below it very often. You could see in recent times, we dipped down to test it. And right here, you can see this long little wick shows that the yield intraday got lower and it went higher. And we were sounding bells here to our Mortgage Market Guide members that, hey, this should probably be a good time to maybe lock some folks. We had a nice decline in rates. We dipped down to close to the 200-day moving average, and we moved higher. Then we went sideways. We went down again. And folks, this was on Thursday, last Thursday, a week ago, where we dipped right down, hit the 200-day moving average, closed above it. It was no surprise that yields could not get above the or beneath the 200-day moving average. And the jobs report came and boom, we went up higher. So now, where are we? Well, there's two things we're watching. Number one, obviously, it's rates cannot get better until the yield, or much better, until the yield gets beneath this yield support at the 200-day moving average, and it's at 336 currently. And then on the upside, it looks like we're kind of drifting this way, right, towards this 380, 385 level, which we're at 373 now. And the big number, the next number, is this CPI print that's coming out next week for January. Now, what's interesting is here we are on a Friday, and just a short while ago, the government released benchmark revisions, seasonal adjustments to inflation reports for both November CPI and December, and those were revised higher, both of them. In December, there was, originally a minus 1/10, and instead it was a positive 1/10. It doesn't sound like much, but over the course of the year, that's a 3% annualized differential. So it is different. So, a lot of risk going into next week, and as fast as this story changed with the jobs report, as fast as this story can change with this CPI print next week. Hope this finds you well. Have a wonderful day, and we'll talk soon. Bye for now.